Okay, so you want to own a water company. Find a source, run some pipes, charge people for what comes out the other end. The math seems obvious. Water is not optional. People drink it every day. They cook with it. They shower with it. They cannot stop using it no matter what you charge. That sounds like the perfect business. Captive customers, no competition, guaranteed demand. The kind of asset that prints money while you sleep. Here is what nobody tells you before you write the check. The water business is not one business. It is four completely different businesses wearing the same name. And the one most people imagine when they picture owning a water company is the one that is almost impossible to enter, the most regulated industry in the United States, and the one where your pricing, your returns, and your ability to raise rates are controlled by a government body that meets twice a year and does not care about your spreadsheet. Start with the structure, because if you do not understand what you are actually buying, you will spend a lot of money buying the wrong thing. The first type is a regulated municipal utility. This is the one people picture: a city water system. Pipes under the streets, a treatment plant, a reservoir, 40,000 customers who have no choice but to pay you because there is no alternative. American Waterworks and Antioch Central Utilities. Middlesex Water. These are publicly traded companies worth billions of dollars that own exactly this kind of system across dozens of states. The asset is real. The moat is real. And the returns are real, modest, predictable, and capped by law. The second type is a private, unregulated water system. Smaller. Usually serves a rural subdivision, a mobile home park, or a commercial property that never connected to municipal infrastructure. These exist in every state. They are not subject to rate regulation the same way a public utility is. They are subject to water quality regulation, which is a completely different problem and a significantly more expensive one. The third type is a water rights business. You do not own the pipes. You own the right to take water from a river, a lake, or an aquifer and sell it or lease those rights to someone else. In the American West, this is a serious asset class. Water rights in Colorado, Arizona, and California trade like real estate. Farmers sell them, cities buy them, investment funds hold them. The business is not distribution, it is scarcity. The fourth type is bulk water. Bottled water, tanker delivery, private well services. Nestle built a multi-billion-dollar business on this. So did Primo Water. The product is water, but the business is logistics and brand, not infrastructure. Four different businesses, four different regulatory regimes, four different return profiles. Most people asking about owning a water company are thinking about type 1, so start there. A regulated water utility is a rate of return business. That phrase is the entire explanation for why the returns look the way they do. Here is how it works. You own a water system. You have pipes, pumps, treatment equipment, storage tanks. All of that infrastructure has a dollar value. Call it your rate base. The State Public Utility Commission, the regulator who oversees your business, allows you to earn a specific percentage return on that rate base. Typically, somewhere between 9 and 11% on equity, set at the time of your last rate case. A rate case is the proceeding where you go in front of the commission, show them your costs, show them your capital investments, and ask for permission to charge customers enough to cover those costs and earn your allowed return. Rate cases take 9 to 18 months to complete. They cost money to file, and the commission does not always give you what you asked for, which means the business model is this: spend money building and maintaining infrastructure, file for a rate increase, wait 12 months, get a partial approval, earn your allowed return on the capital the commission agrees to include in the rate base. Repeat. The capital intensity is significant. A water main running under a residential street costs between $500,000 and $1.05 million per mile to replace. Treatment plants run into the tens of millions. Storage tanks, pump stations, the telemetry systems that monitor everything remotely. An investor-owned water utility with 50,000 connections might have $800 million of rate base assets and earn somewhere between $70 million and $90 million of net income annually. That is a real business. It is also a business that took 100 years and billions of dollars of capital to build. The entry point matters. You are not starting a regulated water utility from nothing. You are acquiring one, and the acquisition price reflects the regulatory asset value plus a premium the market has assigned to the earnings certainty. American Waterworks trades at roughly 30 to 35 times earnings. Essential Utilities trades at a similar multiple. These are not cheap assets. They are priced the way Treasury bonds are priced, as instruments where the return is predictable and the risk of total loss is extremely low. You pay for that certainty up front. The alternative entry point is acquiring a small distressed system, a rural water utility serving 800 connections in a county that cannot afford to maintain its own infrastructure. These transactions happen regularly across the country. A private operator comes in, acquires the system, files a rate case, invests in upgrades, and begins earning a regulated return. The entry price is lower, the operational complexity is higher, and the regulatory relationship is everything. Here is what most people underestimate about the regulatory relationship. You are not a business dealing with a regulator. You are a business whose entire revenue line requires permission from a regulator. Every dollar of rate increase you want to collect has to be approved. The Commission can reject your rate case, reduce your requested return, exclude capital from your rate base, or simply delay the proceeding for another 6 months while your costs keep rising. That is called regulatory lag, and it is the primary earnings risk in this business. Lead pipes make it concrete. The EPA's updated lead and copper rule requires water systems across the country to identify and replace lead service lines. The estimated national cost is somewhere between $45 billion and $60 billion over the next 10 years. For a small utility serving a legacy system built in the 1950s and 1960s, that replacement cost is existential. You file for rate increases to fund the replacement, the Commission approves some of it, the timeline stretches, and in the meantime, you are legally obligated to complete the work whether the rates cover it or not. Water quality compliance is not optional. The Safe Drinking Water Act sets federal standards and the EPA enforces them. States layer additional requirements on top. A single exceedance of a contaminant limit triggers a public notification requirement, a corrective action plan, and potentially enforcement action. The cost of staying in compliance has increased steadily for 40 years, and there is no structural reason to expect that trend to reverse. PFAS contamination is the current crisis. Per and polyfluoroalkyl substances, the forever chemicals found in firefighting foam, non-stick cookware, and industrial coatings, have been detected in water systems across the country. The EPA finalized maximum contaminant levels for 6 PFAS compounds in April 2024. Treatment technology to remove PFAS to those levels costs between $100 and $600 per household served, depending on the system and the contamination level. A utility serving 20,000 connections facing serious PFAS contamination is looking at $20 million to $120 million of required capital expenditure before rates can be adjusted to recover it. If you own the system when the contamination is discovered, and the source of that contamination is a nearby industrial site, you are in litigation before you are in rate cases. The legal exposure alone has ended careers and bankrupted small utilities. Now move to the second type: unregulated private water systems. These are smaller, more numerous, and significantly less understood than their regulated cousins. There are an estimated 148,000 community water systems in the United States. The large investor-owned utilities serve roughly 73 million people. The rest, the small private systems, the homeowner associations with their own wells, the mobile home park operators who supply water as part of the lot rent, serve tens of millions more with almost no institutional oversight of their business practices. The rate regulation does not apply the same way. A private system serving a mobile home park can in theory charge what the market will bear. In practice, what the market will bear is limited by what the residents can pay, which is often not very much, and by the growing attention of state regulators who have begun cracking down on predatory pricing in systems where residents have no alternative. The water quality obligation does not change. A private system serving 50 connections is still subject to the Safe Drinking Water Act if it serves more than 25 people on a regular basis. Testing requirements, reporting requirements, public notification requirements. The compliance cost per connection on a small system is dramatically higher than on a large one because the fixed cost of compliance does not scale down proportionally with system size. This is why small private water systems are simultaneously the easiest to acquire and the most dangerous to own. The purchase price can be very low. The liability can be very high. Consider the arithmetic on a 200 connection rural system. Annual water revenue might be $180,000 if the rate is $75 per connection per month. Annual operating costs, including electricity, for the pumps, required water testing, basic maintenance, and insurance might run $90,000 to $120. Zero operating income before debt service of $60,000 to $90,000 sounds acceptable until you discover the well casing needs replacement at $45,000. The storage tank has a structural issue at $80,000, and the state has notified you that your arsenic levels require a treatment upgrade at $200, zero. All of that must happen whether the rates support it or not. And filing for a rate increase in a county where residents are already struggling to pay $75 a month generates the kind of political attention that brings state oversight quickly. The investors who make money in this space are the ones who know how to navigate that regulatory process, who have relationships with the state agencies, who understand how to build a capital improvement plan that the regulator will approve, and who have the balance sheet to absorb the It is not a passive investment. It is an operating business with a regulatory dimension that requires active management. Water rights are a different conversation and a genuinely interesting one. In the eastern United States, water law is based on riparian rights. If your land borders a river or lake, you have the right to use reasonable amounts of water from it. The right is attached to the land. It does not trade separately. In the western United States, water law is based on prior appropriation. First in time, first in right. The farmer who diverted water from a river in 1887 has a senior claim to that water over anyone who came after. Those rights are quantified in acre-feet. They are recorded in state water court, and they trade. A senior water right on a reliable western river is one of the most valuable agricultural assets in the country. In Colorado, agricultural water rights trade for $25,000 to $50,000 per acre-foot. A farm with senior rights to 1,000 acre-feet of water per year holds water rights worth $25 million to $50 million independent of the land value. Cities facing population growth have been buying agricultural water rights for decades. Las Vegas has spent billions acquiring and developing water rights across the Colorado River Basin. The Southern Nevada Water Authority's water portfolio is as important to the city's survival as any infrastructure asset it owns. The investment case for water rights in the arid West is straightforward. Population grows, climate change reduces snowpack and river flows. The total supply of senior water rights does not increase. Scarcity increases the value of what already exists. The water right is the asset. Everything else is logistics. The complication is that water rights in the West are subject to use it or lose it doctrine in most states. A right that is not exercised can be forfeited. Holding water rights as a purely speculative asset without putting the water to beneficial use creates legal risk. The investment structures that work tend to involve leasing the rights to active agricultural users, while the longer-term appreciation plays out or converting agricultural rights to municipal use through a state administrative process that can take years and significant legal investment. Bulk water and bottled water close the loop. Nestle's water division, now owned by One Rock Capital Partners and rebranded as Blue Triton brands, owns Poland Spring, Deer Park, Osaka, and a dozen other brands. The business model is extraction at almost zero marginal cost, packaging, logistics, and brand. The water itself costs almost nothing. The brand that gets you to pay $2.50 for a 500 milliliter plastic bottle is worth everything. The controversy around bulk water extraction has intensified as aquifer depletion has become visible in communities across the country. Nestle's extraction rights in Michigan, California, and Maine faced sustained public opposition and regulatory challenges throughout the 2010s and early 2020s. Blue Triton has continued to face permit battles in multiple states. The regulatory environment for large-scale groundwater extraction for commercial bottling has become genuinely hostile in many jurisdictions. The smaller version of this business, private well drilling and water delivery services, operates below the controversy threshold, but faces the same fundamental economics. Revenue is capped by what individual customers will pay. Growth requires either geographic expansion or acquisition of competitors. The business is operationally intensive. Trucks, drivers, equipment maintenance, water quality testing, customer service. Margins are thin. Scale is the only path to profitability. So, where does this leave the person who wants to own a water company? The regulated utility is the safest asset and the hardest to enter. You are buying a government-sanctioned monopoly with capped returns and no competition. The entry price reflects that. The risk is regulatory, operational, and increasingly environmental as legacy infrastructure meets modern compliance requirements. The small private system is the easiest to acquire and the most demanding to operate. The returns can be attractive if the system is well maintained, the regulatory relationship is manageable, and the capital requirement is understood before the purchase is signed. The liability can be catastrophic if it is not. Water rights in the arid West are a legitimate long-duration asset with a compelling supply-demand argument underneath them. The legal complexity is real. The holding period is long. The return profile looks more like timberland or farmland than it does like a utility. And bulk water is a consumer products and logistics business that happens to have water in the name. The number most people search when they start thinking about this is the revenue of the largest water companies. American Water Works generated $4.02 billion of revenue in 2024. That number is real. What is also real is that building a business of that scale required a century of capital investment, thousands of regulatory proceedings, and a balance sheet that has never stopped deploying capital into the ground beneath American streets. The water is not the asset. The infrastructure to deliver it reliably, the regulatory permission to charge for it, and the legal right to take it from the source in the first place. Those are the assets. And understanding which one you are actually buying is the only thing that determines whether you make money or spend your life explaining to a state commission why your rates need to go up again.